Quite often we come across clients who are planning to acquire some company overseas, but they don't know as to how to structure their investment. Now, from a financial viability perspective, it's a commercial decision. But when we look at it from a tax and a regulatory perspective, what are the key considerations you should keep in mind is what is we are going to cover as a part of this video. Let's take an example where you have an Indian company which is in the process of acquiring a foreign subsidiary which is based out of European Union. Now, in this case, there are two choices that you have. You can either directly set up a subsidiary under the Indian company, or you can actually set up a holding company which can then set up this subsidiary. The choice of a holding company being in between comes at a point when you're looking at setting up multiple entities and you don't want a transaction directly between India and each of the foreign subsidiary. One of the other reasons for that is also that whenever there is any kind of a remittance from the foreign subsidiary to the Indian company, there's an immediate taxation. Whereas you can always find holding company jurisdictions where the money from the foreign subsidiary can be parked without too much of tax leakage, or in some cases even at 0%, and then this can be reutilized for investment in certain businesses. So coming back to what are the key considerations you should have in mind, we will discuss them now. First is the Indian Overseas Direct Investment Regulations. Now, these regulations basically prescribe as to which sector you can invest in, how much you can invest in, and certain other characteristics relating to the pricing, etc., of the investment. These considerations are different if you're a company. These considerations are different if you are an individual. Generally, for individual, the limit in the liberalized remittance scheme is what is relevant. The second thing is, what is the tax on dividend, interest, and capital gains at the holding company level? So generally, a holding company, once it sets up a subsidiary, is going to receive dividend or interest on debentures or capital gains when it sells the shares of this entity at some date. So you choose a holding company jurisdiction where the amount of dividend tax is low. Let's say, for example, in Netherlands, all these three are favorable. They have a wide treaty network. The taxation of interest is also favorable. And when they sell shares, or the capital gain is also exempt subject to certain conditions. Particularly when a Netherlands company is investing in another EU country, then the tax treaties are almost, as if there is no taxation on movement of funds between the subsidiary and the holding company. The next consideration is what is the withholding tax at the foreign subsidiary level. And this again is going to be a factor of two things. One, the domestic tax rate, which in any case you can't change. But what you can look out for is if this foreign subsidiary has a good treaty network with a holding company jurisdiction, then the chances are that the withholding tax on such payment can be reduced drastically. I tried to cover some of these points in this video. In case you have any issues, you can put them in the comment section or connect with us, and we will be happy to help you out.